Welcome to Market Call. Our guest is Teal Linde, manager at the Linde Equity Fund, and he's going to be taking your questions on North American stocks. You can call Teal right now, toll free, 1-855-326-6266, or send an email, marketcall@bnnbloomberg.ca. Great to see you, Teal.
You too as well.
You notice a somewhat paradoxical effect in the markets right now, or phenomenon. There are concerns about credit, private credit, but the bond market or the credit market is not really, it's just commentary really, but bonds are trading at tight spreads to government bonds. So that indicates confidence.
Yes, that's right. They're basically almost at historical tight levels. And the spread between the high yield bonds and investment grade bonds is very tight. The spread between investment grade bonds and T-bills is very tight. So it suggests that either there's a risk on environment or that there's confidence in the credit markets, which is a good sign for the equity markets, because typically if there's problems in the credit markets, you're not going to see equity markets at all-time highs.
But then we had Tricolor and First Brands running into trouble this year. They were big issuers of private debt. So we heard concerns. This is a yawning problem here. But so far not showing up in the bond market. No,
there was concerns where people were saying, well, there's one cockroach, there's probably many others. But Tricolor and First Brands, they're under right now investigation for financial misconduct and massive fraud. I mean, Tricolor, they were a subprime auto dealership and lender, and they were double pledging. So they were using the cars that they had in their lot and going to banks and getting credit from different banks simultaneously on the same car.
Oh.
So that's not really a reflection of how corporate America is operating.
That's it. And the different lenders, clearly, they allegedly didn't know about this.
No, and one of the banks that got caught now was JP Morgan.
Uh-oh.
And so what's interesting is that all these private lenders, these alternative and private credit lenders, they saw their stocks get hammered, and yet none of them really had any exposure to these companies. It was the conventional banks. But the banks held up and the private lenders went down, and we'll be talking about one of them later.
Okay, looking forward to that. Let's have a look at the S&P 500 today. Do you feel there's complacency in the air, that people are willing to take these AI players at their words that growth will continue for the foreseeable future?
Yes, I think a lot of people are investing in these in S&P 500 ETFs, and I suspect many of them, or majority of them, probably don't realize that they're paying 25 times this year's expected earnings, which is the highest valuation since the dot-com bubble. So there is downside, but typically you need a trigger. Because in 1990s, Alan Greenspan mentioned he had the clip about the irrational exuberance in the market in the 1990s. But he said that in 1996. And if you listened to him and got out, you would have missed 3 glorious years ahead. So the markets can stay expensive, but it really requires a trigger, and that's sort of the unknown.
I think I remember reading years ago that historically in bubbles, a lot of people say, yeah, we're in a bubble, we know it. But they hope they'll find a greater fool to sell whatever they're investing in.
Exactly, the greater fool theory, and they figure that they got 1 foot in, 1 foot at the exit, ready to bolt out. But what typically happens is that it actually starts to fall off and cascade down a lot faster than people expect, and so most people get caught in it.
We're going to be back with Teal Linde of Linde Equity Fund, taking your questions on North American stocks. We'll put that number up again, 1-855-326-6266. David has sent us an email. What is your view on Salesforce?
Is it a buy at these prices? Well, Salesforce, we wouldn't be a buyer. I think Salesforce has had many glorious years. Their best years of growth are behind them. But also in terms of view on the stock, it's in the category of these companies that have millions of users that are buying or subscribing to their software. Let's call them seats. And so there's a big debate going on. Is that business model going to do okay in this new world of AI? Because traditionally, for decades, companies would buy software to help their employees do their job, right? And so with AI, it actually does the job for you. And so if you've got AI software that's doing the job for a number of employees, do you really need them? And do you really need to be paying for those monthly subscriptions? And so companies that have millions of subscription our users are, some people believe they're at risk. And so you have to just really decide, do they have a durable software that's going to continue to be used, or are they at risk of being displaced? And what's interesting in Silicon Valley, the venture cap, when OpenAI first came out, when AI startups were starting to look for money, originally they were using AI to, here, we've got these great AI software to really help people do their jobs better and more efficiently. And that was for the first year, year and a half. But now what they're saying is that don't give us software that's going to help people do their jobs. Give us software that's going to do the job for them. And so, like, for example, don't bring us software that's going to help lawyers do their job better. Bring us software that's going to replace the lawyer.
That's what the clients are saying.
The venture capitalists.
Oh, I see.
Yeah, bring us a startup that's not going to help the law firms or accounting firms. Bring us a startup that's going to digitize and replace them.
One question I have is, if companies are going to be making us deal with AI, not a person, if the AI tells us something, can we take that to the bank? Is that a legal commitment by the company?
Well, that's why you probably can't eliminate the entire staff. You're going to have people that sort of, the architects, the supervisor, that have to sort of make sure the quality control is there.
Yeah.
But that's going to require a lot less people. I mean, there's a lot of talk about and there's a lot of criticism that people aren't talking enough about the negative impact that AI can have on employment. And so when you have companies, that's why, getting back to Salesforce, or other companies that have millions of users, subscribers, is that business model going to work in a world of AI?
Let's head to Niagara, Ontario. Peter, go ahead, please.
Hi, good afternoon, gentlemen. My question for Teal is on Enbridge. I'm looking for a large cap Canadian company that pays a high dividend, and I believe Enbridge checks off all those boxes. Can I please have your opinion? Thank you. I'll hang up and listen.
Thanks.
Thanks for your call. Yes, Enbridge would qualify. The dividend yield is about 6%. And right now, I mean, after 2026, they expect that their adjusted EBITDA, earnings per share, and distributed cash flow will sustain at a 5% rate year after year after year.
What, sorry, sustain? You mean grow? Or,
yeah, grow at a 5% rate. I mean, for 2026, they expect the adjusted EBITDA to grow like 7 to 9, earnings per share 4 to 6%, and distributed cash flow 3%. And so, but after 2026, they're forecasting 5% growth on all those metrics. And so, if you have a 6% dividend yield like you have today, and they're going to continue to grow at 5%, you have the total return potential of 11%. Now, the stock's going to go move up and down, but if the caller is interested in something long term, that's a pretty attractive return for a blue chip Canadian stalwart.
Give us the math there again. So the cash flow grows at about 5% a year.
After 2026, they expect it to be 5% for the foreseeable future.
And the dividend itself, the yield is about 5%.
6% right now.
Right.
Yeah. And so the combination of a 6% yield that they've figured they can continue to grow at a 5% rate of return, that's pretty attractive.
Yeah. And I mean, pipeline stocks, do you think the attitude has changed to pipeline stocks? They used to be seen as very boring. You would get your dividends and not much growth.
Yeah, well, they've come, well, it depends what area. Like, I guess one of the knocks on Enbridge is it's very heavy to oil, and oil demand is not growing at that much. And so compared to, let's say, natural gas. Natural gas has the benefit of being able to take advantage of the coal to natural gas transition, onshoring of industry, LNG exports, and demand for energy demand for data centers. And natural gas is probably the best source, because when all these data centers are being built out, there's a lot of talk about nuclear, but it takes like 10 years to build a nuclear plant.
At least.
There's talk about renewables, solar and wind, but it's not, as data centers need very steady, consistent energy supply. And so natural gas is actually probably the best source, because there's a lot of supply out there, and it doesn't take too long to build the plants and get the electricity flowing to the data centers.
Let's head to North Bay, Ontario. Go ahead, JC.
Hi, I'd like to ask about Ensign Energy. These service companies, especially the smaller ones, have kind of underperformed the producers. Do you think there's some upside still here? And do you think it'll initiate a dividend anytime soon?
Thanks.
Thanks for your call.
Ensign Energy.
Yeah, Ensign, we've talked about it for quite a while.
Yeah.
And it's, the call is correct. It is underperformed relative to where it should be. I think it's undervalued. I mean, the company is about to, by the end of next quarter, pay down $600 million of debt. And very little, typically you see when a debt gets paid down, that value gets transferred to the equity holders. And we really haven't seen that. And so I think what it probably will take to move the stock is what the dividend, as caller suggested, would be the reinstating the dividend. Because before COVID, or 2018, it was paying about 46 cents a share. And so when the stock is around where it's at now, that's almost a 20%, almost 20, well, 17, 18% yield. And so if they were to reinstate the dividend after they stop using their cash flow to pay down debt, I think that could really put some upside to the stock.
BMO is downgrading the stock today to a hold. Just saying the stock has rallied about 30% since August. They just see better opportunities in other oil field services companies.
Yeah, I think for the next year, it's difficult to say because I know that they have the $600 million target and they've extended that by next quarter. And then they still have plans to pay down some other debt, I believe, next year. So it's probably not going to be until they've completed all their debt down plans, debt pay down plans, where they can either start buying back a lot of stock at this inexpensive valuation or reinstate the dividend. I think in hindsight, I look at the performance of Ensign and I consider it as a stock that sort of has suffered the outcome of a lot of value stocks and the whole value investing sort of approach over the last 10 years.
Going to take a break. We'll be back with Teal Linde and we'll get Teal's take on Microsoft. Bob is calling from Toronto. Go ahead, Bob, please.
Yeah, hi, Andy. Thanks for taking my call. Teal, Microsoft, it hasn't been doing very well, and I don't know why. I'm still ahead on it, but my profits are being eaten up by the fact that the stock is going down. So I'm wondering if you can give me sort of your ideas as to what's happening. Thanks a lot.
Thanks. It is off its highs of July.
Yes, yeah. It is. But I would suggest that where it's priced right now is a decent entry point. Like if you wanted to have an opportunity to buy some Microsoft, you could do it now. And one of the reasons why is that the company is doing really well. I mean, it's often been considered an AI beneficiary, and it is participating with its partnership with OpenAI. However, in their recent results, they're showing a lot of strength in their non-AI parts of the business. Like their Azure cloud business, the majority of that business is still non-AI, and it had phenomenal growth rates. And even their productivity suite, their Office suites with Excel and Word, 20% growth just in the last quarter.
So they don't necessarily need AI.
No, so it's across the board growth, and they're well positioned for AI as well going forward.
So you'd be a buyer of the shares?
At this price, yeah, it's a good entry point. In considering, and one of the advantages of Microsoft is they're not reliant on advertising. Let's say Meta, for example, which is 98% advertising revenue, and even Google has a large chunk of that. Microsoft is very sort of entrenched into commercial products and business products and productivity products, and less reliant on advertising.
Let's hear now from one of our regulars, Andre in Chilliwack, BC. Go ahead, Andre, please.
Oh, good day, Andrew.
Okay.
I hope everything is well.
All good, thanks.
Oh, good. Mr. Linde, could I get your thoughts, please, on Five Below? I don't think you own it anymore. Maybe you do. Could you give me your advice, maybe for a seasonal trade? It seems to be coming back quite well. Is it a turnaround story, or is it something that you could buy at this current level? Thanks, fellas.
All right, thanks for your call. Five Below, we still do own it. We wrote it down, but the dollar stores in general have been lifting recently. And Five Below has been doing the best. I mean, they're still growing their store base at about a 9% rate, but their same store sales in a recent quarter are up like 12%. And so they're going to experience close to 20% revenue growth this year. And so what's happened there is that they've got a new CEO who's just doing things slightly different than the prior management teams, and focusing really on being, more on trend. I mean, they've always tried to sell trendy products, but Winnie Park is the new CEO, and she's taking that further. I mean, she's taking advantage. For example, like Korean media is becoming bigger and more popular in Western culture, and so they got popular Korean foods and candies, And also one thing they're doing differently in the store is that the prior management team had what's called Beyond 5, where they had more expensive products in a portion of the store. What she's done is she's putting these more expensive products, sort of scattering them throughout the store, so you have a kind of a treasure hunt experience when you're walking around the store and you find something that is more than $5, but you like it, you're going to buy it. And so it's all good. The only problem is that it's trading around 30 times earnings, which is expensive, but we still own it. There is the upside in that the margins haven't gone back to where they were before. And so once the margins start to recover back to where they were, we're probably going to exit the stock.
Because it'll bring up the shares and then you'll go.
Yeah, and then the growth rate is slowed down in terms of the number of stores. And that was the main reason we bought it. And so they really decelerated on that front. And we don't want to rely on having to buy a company, a retailer, where they just relying on same-store sales, having to go up every quarter, because that's difficult to sustain.
Right. Yeah. So what do you look for in a retailer then again?
Well, we want the Five Below's their margins have not come back up to where they were before. And so that, I think, is a source of upside still.
Okay, Okay. We have an email from Sunny in Brampton, Ontario. What does our guest think about Shopify?
Shopify is leaning in hard into AI. And I know I've been critical about the valuation, but I've been reading about it more recently. And there's reason for people to be excited about it. I mean, one of the things that they have on their operation front is that they have AI as the baseline. They have a policy that no one gets hired unless you can prove that AI can't do the job. All right? They are introducing AI for their merchants to use when they're building and designing and changing their websites and their e-commerce presence for their customers. And then one thing I just read briefly is that they're introducing what I think is the Shopify catalog, and where you remember the Sears catalog?
Oh yeah,
right? You could leaf through it.
Sure.
Okay, so the AI version of that is that you have an agent, and you basically tell it what you're interested, what you're looking for, and it will go and it will look at all the merchants that are on the Shopify network, find what you're looking for, and even process a transaction for you.
Right. I wonder, will it give you a bunch of junk that you're not looking for? That's the problem with an Amazon search these days, I find sometimes.
Exactly, because Amazon sells a lot of lower quality product. And I think Shopify, because I was actually thinking about that, and I think like people that have their own standalone Shopify site, I think are generally higher quality vendors than those that are just flogging their stuff on Amazon, generally speaking.
Yeah. I mean, you can find stuff with Amazon search, I just find it so noisy.
Yeah,
sponsored and all that.
$50 billion a year that Amazon's generating from all that sponsorship revenue.
Right. We've got Elliot on the line from Hamilton, Ontario. Go ahead, Elliot, please.
Good afternoon, gentlemen. I'm interested in FirstService. It's down dramatically, but I've seen actually no change in the company's operations per se. Is this just a multiple compression? Please, your thoughts on FSV.
Thank you.
Thank you very much. FSV, that was actually a stock. It was on our short list for a top pick. Didn't quite make it, but I think that says a lot right there. Because FirstService has come off. Their growth rates have come off recently. But this company has had such a great long-term track record. I think it's a buying opportunity. Like whenever you have a company that has a stellar long-term track record that has a short-term stumble, it's usually an opportunity to pick up some shares. And so one of the advantages of FirstService is that it's North America's largest property manager for multifamily residences. And that's about half the business. The other half of the business has got a collection of service companies that service buildings for maintenance, like roof repair, fire protection, restoration, right? And these are good because they're not really economically sensitive. They're kind of things you got to do when you have a problem. And so the sort of the business model of FirstService is to grow at a single-digit rate, and then to use acquisitions to bring the growth rate into the double-digit return level. And so I think this is actually a decent time to pick up shares.
And sorry, did you tell any particular reason why the stock would be down lately?
Oh, because the growth rates have come off, yeah.
Okay.
And so that's to cause the stock to come down.
Okay.
But I think that'll be just a temporary situation.
No problem. We are going to take a break. When we come back, we'll check out Teal's past picks. Teal was on our show November 4th of last year. UiPath was his first idea. This one up more than 30%. What do they do, Teal?
UiPath is the leading provider of robotic process automation. And so during COVID, it did great because that's when people were in the offices and digitization was a big deal. And so it IPO'd at that time, but then it's sort of fallen from grace. And it was recommended just over a year ago because of the sentiment was very negative. And I thought that, well, this is a company that has robotic process automation, is where they basically have software that automates the repetitive tasks of workers in front of their computers. It's not AI, but I thought, well, that's like a precursor to AI. And with all this AI technology coming out, I thought they'd be pretty well positioned. And if they were to just move into that area, the sentiment would lift, and that would probably boost the stock. And that's what happened in the end of September. They announced partnership with NVIDIA, OpenAI, Google, and a couple others, and the stock rallied 47% in 10 days. And then within 5 weeks later, it was right back down to where it started. So missed an opportunity to capture that gain. But then just over a week ago, they announced their quarterly results. And they weren't great, but they were good. And then they talked about the interest that customers are having in their AI products, and the stock rallied right back up to where it was in October. And so this time we thought, well, we're not going to ride this one down. So actually, last Monday we sold our entire position at around $19. I know the stock is down around just over 16 today, but if we owned it today, we'd still sell it.
Okay, no problem. TD Bank, this one's had a nice run.
Yes, TD Bank was in the penalty box a year ago because of all the troubles they had on the money laundering. They had a change in leadership. They pulled their guidance. It had the most number of sell and hold recommendations on the stock by the analysts in years. And yet, if you were able to put aside the opinion of the analysts and buy the stock, TD became the best performing Canadian bank stock over the last year.
And so, obviously, their growth in America curtailed. Parts of their business can't grow.
Yes.
Maybe that's a good thing. They earn fat profits here in Canada.
I totally agree. I think that the more that the Canadian banks go into the United States, the more they become Americanized and their profitability suffers, because the profitability of banks in America are less than Canada, right? So I think, to your point, that the fact that they have to go back to Canada and find business opportunities here is probably a good thing.
And of course, the executives don't get to swagger in the same way if they have big U.S. operations.
That's right. It's easier to do acquisitions down there, but if you can't do that, you're going to stay home.
Okay. And finally, Alphabet. Let's see how this one did. Wow, almost a double.
Yeah, Alphabet, again, similar to TD Bank, Alphabet was also out of favor a year ago because there was concerns that it was going to get broken up. There was concerns that its dominant search engine after 20 years was finally getting some serious competition from these AI chatbots. But neither of those fears have been realized. And Alphabet has now sort of been benefiting from the success of its Gemini 3. And there's growing belief that Alphabet will likely become the most valuable company in the world. Because if you look at the AI world, it basically has what OpenAI has in Gemini 3, Gemini. It has what Microsoft has with their cloud, because they got Google Cloud. And then it also has the chip design capabilities of NVIDIA with their TPU chips. And so it's really an all-in-one AI vertically integrated AI machine.
And Alphabet has been the top Mag 7 stock this year by a long chalk. It's up about 62%, and NVIDIA is up 33%. It's number 2.
Yeah, that's right. And the advantage that Alphabet has over NVIDIA is providing chips to build out the infrastructure, right? But once the infrastructure is built out, the order book's it's going to drop off quite dramatically. But the providers of the AI technology will continue to be in business offering their services.
And Amazon is the dog of the Mag 7. It's up only about 2%. Or total return.
Yeah. And so actually Amazon's a stock that we think you could actually consider nipping away at it because what they're doing they've got their Amazon Web Services doing well. They do have the AI exposure. They're designing their own chips. And their e-commerce, they've just recently announced Amazon Now, where you can get delivery in 30 minutes or less for thousands of different products. They've only rolled this out in Seattle and in Philadelphia. But that's probably just the beginning.
Yeah, now. Instant gratification. Okay, Teal Linde of the Linde Equity Fund is taking your questions on North American stocks. We'll be right back. Let's head to Peace River, Alberta. Jim is standing by. Go ahead, Jim.
Good morning, guys. I was wondering about Tourmaline. TFSA season is coming in January. Add $7,000. I'm trying to figure out who would be my best pickup then. I own Tourmaline. I like them. Is that a good pickup for January? Thank you.
Thanks.
All right. Thanks for your call. Tourmaline, if you look at the stock over the last few years, it's really sort of been pretty range bound. And so I think, and this applies to most resource stocks, that you really want to pick your entry points because they make a difference because they don't grow that rapidly, but they move around a lot. So you can augment your returns by when you buy it. And so with Tourmaline, with TFSA money, I would prioritize put the money in the TFSA and wait for the stock to be, let's say, at a 52-week low, and then deploy your cash.
Right.
It's worth waiting for that to happen.
Because it's volatile enough, that's going to pay off.
Yeah, you can probably get just a 10% lift just by doing that, in addition to the longer term growth rate, which is slowing down.
Okay.
Yeah.
We've got Chad in Saskatoon. Fire ahead, Chad, please.
Good afternoon, gentlemen.
Hi there.
My question for Teal today is on Telus. Sort of the same thing as the previous caller with the TFSA amount coming due in January. At these levels, would he add to the position, and what does he think of the telecoms in general? I'll hang up and listen. Thank you.
Thank you.
All right. Thanks for your call. Well, this is a situation where the stock is at a 52-week low, and it's got a 9% dividend yield. And so there's concern, is it going to go down the same path as BCE and cut the dividend?
Right.
And so
they say they're freezing it for now.
They're freezing the growth.
Yeah.
The growth target at 3 to 8%. And I guess one advantage that Telus has in preserving the dividend is that they've got a lot of their capital expenditure from the fiber to the home basically done. They were sort of early in that. And so they got it done. And so they're going to be able to take advantage of the free cash flow that they can generate for the company as a result of that. And so that should give them some protection on the dividend. And but even the valuation has come down to a more reasonable level. So if you were to buy it in your TFSA and get the 9% dividend, if they sustain it, that's an attractive return. And there's an opportunity for the stock to bounce back as well if the confidence comes back on the company.
Is the market telling them, though, that this dividend is too high? It's around 9.5% now.
That's generally the case. When the yields get that high, it is the market sort of saying that it's too high. And that's one of the reasons why they decided to curtail the growth. I mean, if you've got a 9% dividend, people don't need to grow that. You don't need to grow a 9% dividend yield to make it attractive. It is attractive as it is. And so I think what the company wants to do is to instill greater confidence in their growth outlook. And so if they could do that, then perhaps the stock can get bid up and the dividend yield come back to a more reasonable level.
Paradoxically, sometimes when companies cut the dividend, the stock goes up because the market was waiting for it.
We've seen that too. Yeah.
Sometimes happens.
Yeah, it does happen. It does happen quite a bit. And so, but with the caller also, what do you think of telecom in general? I mean, telecom stocks used to be sort of part of the group of utilities and pipelines and telecom. And it was like that for decades. But and the reason why it was part of that utilities and pipelines because of the monopolistic nature that those businesses typically have. And so when the telephones used to be all landline, they have their copper networks all over a region. It was really difficult for someone else to come in there and lay down the copper and trying to get new business. It didn't make sense. But now with cellular technology, it's easy to just put the base stations and put the cellular technology equipment on different towers, and you can go into your competitor's backyard. And so what's as a result, you have a lot of competition, and then it's basically all the pricing advantages are gone, profitability is squeezed, And so telecom is not as attractive as it used to be because of the heightened competition that they can all go into each other's backyards and try and steal each other's customers.
And in some cases, competitors piggyback onto your own equipment as well.
That's right,
Yeah.
if the governments enable that to be allowed.
Michelle is in Vancouver. Go ahead, please.
Hi, Andrew.
Hi.
Can I get your thoughts on Meta? Do you like the stock for the long term? Thank you.
Thanks a million.
All right, thanks for the call. Meta is a stock we do not own. And of the Mag 7, it's the one that we consider to be the one that's probably the most vulnerable to a recession. Because, like I said earlier in the show, 98% of their revenues come from, or maybe 99%, from advertising. Mm-hmm. And when there's an economic recession and companies have to sort of look for ways to save money, the marketing budgets are often the first places to get cut. And we saw that in 2022 when there was an economic slowdown and interest rate going up. Meta saw its share price fall significantly. And so when we went with our fund and clients' portfolios, we're always looking, where's the downside risk? And that's probably the biggest downside risk to Meta is an economic slowdown, marketing budgets get hit, market cut back, and then the revenues and earnings get curtailed and the stock, the multiple contracts and the stock goes down.
So would you be a buyer of the shares right now?
No. I think, having seen what happened in 2022 and how poorly it performs when there's an economic slowdown or recession, that's probably a good time to be buying a stock like Meta because it's obviously have this durability to come back.
We have another caller from Brampton, Ontario. Mike, go ahead, please.
Hi, Teal. Hi, Andrew. Great show.
Thank you.
Listen, I own some Brookfield Corp, BN, and I want to add over time. So I was wondering what your mid to long-term thoughts are on Brookfield Corp, and if there's any other types of similar stocks like maybe Blue Owl or something like that that I can also get into. But my main question is on Brookfield Corp. Thank you.
Brookfield.
Okay, Brookfield, thanks for your call. Brookfield is tied for second, third largest holding in our fund. And we're big fans of the company and the stock. And one of the things that obviously, because we're a growth-oriented fund manager, is that the growth outlook is incredible, actually. I mean, for a company of its size, at their last Investor Day presentation just a couple months ago, in September, they provided their outlook, and they expect their distributed earnings to grow 20%, their core distributed earnings 20% over the next 5 years. And when they include the carried interest, that'd be at another 5%, 25%. And so those are phenomenal numbers, and people often wonder, like, how can they do that when they're such a large company? But Brookfield's in a situation where they're able to use their scale to their advantage. They're doing things that you need the large scale to do. And so 20 years ago, when they were a smaller company, they had to compete with lots of other companies. But now they have fewer competitors that they have to deal with because the kind of projects they get involved with require scale.
They're so big.
Yeah, and for example, I mean, they're a large. They own. They're a large builder and owner of data centers. And if you want to build a data center, you have to get permitted. And one of the big problems with data centers is the pushback is that it uses up a lot of electricity and a lot of power. But Brookfield also has they own Brookfield Renewable Partners, and so they can combine the two. They built the infrastructure expertise to build the data centers. They've got the energy supply to approve the permitting, and that's sort of an example. Like there's other companies they don't have that sort of advantage.
Yeah. And they're certainly a global player, and they're jumping aboard this AI data center thing in a big way.
Yes,
it's tens of billions of dollars they're talking about in investments.
Yeah, and what's interesting also, I mean, Brookfield Asset Management is their biggest subsidiary, and so they have it's an alternative investment management firm. And if you look at the 50 largest institutional investors that invest in alternatives, 39 of them are clients of Brookfield Asset Management. But Brookfield Asset Management, it's only got about 2% of their wallet, right? So only 2% of those 39 companies are invested in Brookfield. And so you can see there's an opportunity to increase that 2% to 3% to 4%. They want to double their fee-bearing capital, Brookfield Asset Management, over the next 5 years.
We're going to be back with Teal Linde of Linde Equity Fund, taking your questions on North American stocks. Kevin is standing by in Ottawa. Go ahead, Kevin.
Hi there. Teal, thank you for taking my call. It is on Visa. I've been a long-time shareholder of Visa. I think I got in about 6 months after its IPO in 2008. But the last year and a half, something is amiss. Its share price is very flat. I've never seen this quite before. Even with its $20 billion share buyback, it's not moving. It's strange. It hasn't acted like this since its IPO. And I'm wondering, maybe you have an insight, and would you buy it? Thank you.
All right, Kevin, thanks for your call. We own Mastercard, and we continue to like it, and so they're very similar, and they're almost interchangeable. The only difference is Mastercard grows a little faster, but you have to pay a higher valuation for it. And so to the caller's question about it hasn't done anything in a while, and I would suggest if you go back a couple of years, the valuation of the Mastercard and Visa was pretty high, and then the growth rate started to decelerate. And so at the beginning of this year, the growth rates for Visa and Mastercard, the revenue growth rates were 10% for Visa and 12% for Mastercard. And so that was really slow. That's the slowest I've seen it in the many years I followed it. And so I think that sort of dampened the outlook for the stocks. Now the good news though is that the revenue growth rates are actually doing better than that. It looks like Mastercard is going to clock in around 16%, which is pretty incredible, and Visa is also going to be I think 11 or 12. And what's happening is where they're seeing an increase of growth is largely in the cross-border transactions, because they make a lot of money on cross-border transactions, and there's a lot of that, and that's a growth area because there's a lot more people traveling, and when you travel and you use a credit card somewhere else, Visa and Mastercard they're making more money on that type of transaction than they do when you're staying at home. And then, of course, e-commerce. There's a lot of e-commerce going on where you're buying products from outside of your country, and they get a larger fee from that. And so you've probably noticed that Visa and Mastercard in the last couple of weeks have actually picked up in their share prices. And they've got actually I think there's been upgrades for both companies lately.
So would you be a buyer then of Visa right now?
Yeah, it's you could pick away at it. It's I mean it's the valuations they're trading at premium, so you probably want to obviously buy if there's a downturn in the market, you probably get a better entry point. But they call it these are long-term holds, so you can start accumulating a position now.
Capel is calling from Oakville, Ontario. Go ahead, please.
Hello, hi Andrew. Great discussion. My question is on Apple. We know that they have the least exposure to AI. At the same time, iPhone 17 sales launch had really been, they really went successful there. But we also know there were some geopolitical tensions going on because of their production facility in China moving to India. So just wanted to get your thoughts on what would be the best entry point, if at all you like the stock. Looking forward to your thoughts, and I will hang up. Again, thank you so much.
Thanks.
Okay, thank you for your call. Apple is finally showing some growth. For like 3-4 years there, the growth was negligible. But the iPhone 17 has done well. And in China, their business has picked up there as well. And so the stock has moved up. But I would say it's fully valued at this price level. I mean, it's still a single-digit % grower. I mean, at least it's growing, but it's only single digits. And the valuation's over 30 times earnings. And I guess what's part of the reason why the stock's gone up is the outlook for next year. I mean, they've come out with their iPhone. Their I guess what is it? It's their thinnest one.
Yeah.
And it's their thinnest phone. But what's more interesting is that there's talk that they're going to come out with the foldable version.
Yeah.
And so Samsung's got that as well. And that would be a huge, I guess, improvement or change in the hardware, where you get the phone where you can sort of open it up. Well, you get the screen on one side, but you can open up like a book, and you have the wider screen. And so that it already exists out there. But the problem with that phone, the current providers, is there's a seam. There's a seam in the middle. And apparently the seam gets worse as time goes by. And so Apple, being the perfectionist, there's anticipation that they're going to actually solve that problem. So it'll be it'd be just a uniform screen. And if they did that, particularly for the older people who need that, or hard of seeing, it'll be a benefit there. So I love the company. The stock's at a 52-week high. You're better off buying on a pullback.
Okay. I wonder, will the providers of instructions or ingredients ever make the type bigger. I cannot believe.
I know. I guess they assume no one's going to be reading them. But
Yeah.
but you're right. The fine print, right?
Oh, my goodness.
Yeah.
Anyway, we're going to take a break. We'll have a look at Teal's top picks when we come back. Join us tomorrow on Market Call. Gordon Reid is our guest. He's president and CEO at Good Reid Investment Counsel. The topic, U.S. equities. Let's get to the top picks from Teal Linde, starting off with Uber.
Yes, Uber is a company where people might think that it's already so ubiquitous. Why is it too late to buy? But no, they're still growing very, very at a very rapid rate. Just last quarter, they had the number of monthly users increased 17% year over year of users of their drive and food delivery. Food delivery actually is growing faster than mobility. And then there's all this talk about, will these robo-taxis be a threat to Uber? And they're being very proactive in making sure that they're going to become the distribution layer. They've got partnerships with 20 different autonomous vehicle makers around the world. And so there's basically a viewpoint that people aren't going to have different apps for these different autonomous vehicle makers. And they might just centralize it on Uber. Because right now on Uber, you know how you can choose between your economy car, you can get a large vehicle, you get an electric vehicle.
Yeah.
There'll be the autonomous vehicle as well. And then this is thinking long term, but when you have more autonomous vehicles out there, the cost of taking an Uber is going to drop a lot, right? Because you're not having to pay for the driver. And then you're going to get in a situation where, do I want to drive downtown, look for a parking place, pay this outrageous parking fee and walk to my spot? Or do you want to just have door-to-door service and take an Uber? So we like it. Its valuation is also pretty reasonable too.
It's going to be interesting too. Apparently, one vision for the automatic cars is that they'll work together. If there's congestion up ahead, they'll start moving, taking other routes, and they'll be more efficient as well in the sense that they won't be daydreaming when traffic starts again. They'll start more promptly.
Yeah, absolutely. Like if you use Waymo, apparently people have told me they've used it. Right now, if you want to get a call, if you want to call a vehicle, you say where you want to go, and then Uber will send it out to the different drivers, and the drivers will look at it and they'll consider whether they want to do it. But with the driverless cars, it's automatically it's chosen. It comes and gets you. Another thing is you don't have to tip the driver as well in an autonomous vehicle, so you save money that way too.
I'm sure they'll find some angle whereby you got to tip the programmers. Yeah. They'll all be AI. Yeah. Blue Owl Capital. I got mixed up. This isn't on a past picks, but this is a big player in private lending.
That's correct. And it got dragged down with all this fear that there's problems in the credit markets. But again, we talked about how the credit spreads are really tight. Some people suggest that they're the tightest ever. All right, and then if there were problems in the credit markets, we all know that the bondholders take priority ahead of the equity holders. So if there were problems in the credit markets, the stock markets shouldn't be trading at all-time highs. And then I guess the final piece of evidence that the stock has been oversold is that Blue Owl Capital has a separate publicly traded fund that invests in private credit investments. And insiders from Blue Owl Capital invested $115 million of their own money taking advantage of the sell-off. So all these factors suggest that Blue Owl has been sold off. It's trading at around, 17 times earnings around there. Typically, alternative investment managers trade between 20 to 30 times. And so we see upside there. And you collect a 5.5% dividend while you're waiting for the recovery to happen.
And then finally, Pinterest. Don't seem to hear much about them these days.
No, Pinterest, but the growth and valuation metrics are very impressive. And the stock recently took a tumble when it announced their last quarter's results. And it has a history. If you look at the last 21 quarters, Pinterest, the stock reaction to the results has had an average jump or decline of 14%, with the largest gain being 36% and the largest fall being 18%. So just recently it fell 17% on a slight miss, right? And so right now, next year, they're expecting revenues and earnings to grow 15%. And is trading around 13.5 times next year's expected earnings. So generally speaking, whenever you have a company growing in the mid-teens and the valuation is also in the mid-teens, it usually turns out to have been a buying opportunity.
The shares peaked out at $89 there in 2021, and they're only about 26 now.
Yes. And what's happened since then is new management has come in around 2022. and they're really leveraging AI to increase the user experience, make the ads more effective. They've had the actual accomplishment of increasing the number of ads it displays, and the user experience, and users still saying that they're increasing their satisfaction ratings of the service.
Yeah, they're trying to get into TV advertising. They just bought a connected TV ad platform called TV Scientific.
Yes. Yeah, and they're doing that, and also they're also making it so that people, instead of going there for looking for inspiration, which is traditionally where people went to, it was to get ideas, for creative ideas, for decoration, for recipes.
Yeah.
They are now want to make it possible that when you find something in Pinterest that you can buy it.
Oh yeah, that's the new thing.
Yeah, and it's actually, that was the original intent of Pinterest when it was first created, was to be a spot where you can go and buy stuff, but they couldn't compete with Amazon, so they said, well, it'll just become an inspiration spot. But because they have so many people viewing it, and well, let's go back to our original plan and allow people to buy what they're looking for through the site, and that'll be another source of revenues and earnings for the company going forward.
Teal, thank you very much indeed.
That's great to be here. Thank you.
Teal Linde has been our guest on Market Call. Gordon Reid is up tomorrow. Thanks very much for watching.